This analysis shows the most contrarian insight in finance right now. Your boring 5% savings account is beating 60% of stock investors. While every financial advisor tells you to always invest, the data reveals a different story that could protect and grow your wealth in 2026. Looking at performance data, $10,000 in cash earned more than stocks in 2022, and current high-yield savings accounts paying 5% are outperforming most active managers. This chart displays how we've entered a unique window where cash provides both protection and opportunity that most investors are missing. What emerges from institutional analysis is that smart money understands something retail investors don't. Sometimes the best investment is no investment. Warren Buffett holds $157 billion in cash. Apple maintains $162 billion in short-term investments, and money market assets have hit record highs of $6.1 trillion. This yield analysis shows we're experiencing the highest cash returns since 2007, fundamentally changing the investment landscape. High-yield savings accounts now offer 5.5% annual returns. Money market funds provide 5.2% with daily liquidity, and 6-month CDs deliver 5.8% guaranteed returns. Looking at the historical context, cash earned essentially nothing for over a decade. 0.1% was standard from 2010 to 2022. This chart demonstrates how Federal Reserve rate hikes created a 50x increase in cash returns, from 0.1% to over 5%, representing the most dramatic shift in cash competitiveness in modern history. What the mathematics reveal is that 5% risk-free return creates genuine competition for stock market investing. When you remove the best 10% of trading days from historical stock returns, the S&P 500 century-long average drops from 10% to just 4.2%, making your savings account suddenly competitive. This performance comparison reveals why 2022 became a wake-up call for concentrated stock investors. The S&P 500 dropped 19.4%, while the Nasdaq fell 33%, turning $10,000 investments into $8,000 losses. Meanwhile, cash investors earned $500 on that same $10,000 with zero volatility. Looking at broader market patterns, this analysis shows that bear markets occur roughly every 7 to 10 years, lasting 12 to 18 months on average. During these periods, cash doesn't just preserve wealth. It provides opportunities to buy assets at fire sale prices when everyone else is panicking about their losses. What emerges from risk analysis is that volatility works both ways, but only cash provides optionality during downturns. The same momentum that drives stocks up 20% in good years becomes the force that drives them down 30% in bad years, creating sequence risk that cash completely avoids. This institutional positioning analysis reveals how the world's most successful investors are thinking about cash in 2026. Warren Buffett's Berkshire Hathaway holds $157 billion in cash, 28% of their entire portfolio, while Apple maintains $162 billion in cash and short-term investments despite generating massive profits. Looking at the strategic reasoning, this data shows that optionality has quantifiable value that most investors ignore. When markets crash, having cash allows you to buy assets at discounted prices while leveraged investors are forced to sell. This creates wealth transfer from the unprepared to the prepared. What institutional analysis reveals is that cash hoarding isn't bearishness, it's intelligent positioning for uncertain environments. Smart money understands that preserving capital during downturns creates more wealth than chasing returns during bubbles, which explains why money market assets have reached $6.1 trillion in 2026. This crisis analysis demonstrates cash's protective power during major market downturns throughout history. From 2000 to 2003 during the dot-com crash, stocks lost 37%, while cash earned 6.5% annually. During 2007-2009's financial crisis, stocks fell 48%, while cash delivered 4.8% returns with zero volatility. Looking at the wealth preservation patterns, this data shows that avoiding major losses matters more than capturing every gain. Missing the 10 worst market days over 30 years would have increased returns by 4.1% annually, demonstrating the mathematical value of defensive positioning. What emerges from behavioral analysis is that cash provides psychological advantages that improve long-term investment performance. When you're not worried about portfolio volatility, you make better decisions about when to deploy capital, avoiding the emotional buying and selling that destroys wealth. This Fed policy analysis reveals why the current 5% cash yield environment creates a strategic opportunity for patient investors. With the federal funds rate at 5.5% and Fed signals indicating their near-peak rates, we're in a unique window where cash provides attractive returns before the eventual cutting cycle. Looking at interest rate cycles, this duration strategy shows that holding cash during rate peaks positions you for multiple opportunities. As rates decline, you can lock in longer-term yields, and as markets potentially struggle with changing conditions, you have capital available for opportunistic investments. What the strategic framework reveals is that cash allocation should be adaptive, not static. The optimal strategy isn't cash or stocks, it's cash then stocks, using high yields to preserve capital during uncertainty while maintaining dry powder for deployment when opportunities emerge. This engagement analysis shows that viewer participation helps us understand real-world investor behavior and challenges. Tell us in the comments, what percentage of your portfolio do you currently hold in cash? And how has that allocation changed since interest rates increased? Looking at institutional trends, this data reveals that smart money has dramatically increased cash allocations from 3.1% in 2021 to 5.8% in 2026. Endowments typically maintain 5 to 15% cash in normal environments, but increase to 20 to 25% during uncertain periods like we're experiencing now. What emerges from crowd wisdom is that retail investors often do the opposite of institutions, holding minimal cash during uncertain times while institutions build defensive positions. Your comments help us understand whether Premium Logic Lab viewers are thinking like institutions or following the crowd. This real return calculation demonstrates why the inflation will destroy cash argument doesn't hold up in 2020 SIXS environment. With current inflation at 3.2% and cash yields at 5%, you're earning plus 1.8% in real terms, positive purchasing power growth with zero risk. Looking at the mathematical framework, this analysis shows that risk-adjusted returns favor cash when uncertainty is high and yields are attractive. A 5% return with zero volatility mathematically beats a 7% return with 20% volatility when you factor in sequence risk and liquidity needs. What the inflation hedge analysis reveals is that cash becomes more attractive as inflation continues falling toward the Fed's 2% target. If inflation drops to 2% while cash still yields 4%, your real return improves to 2% annually with perfect liquidity and zero principal risk. This allocation analysis reveals how the world's most successful long-term investors think about cash positioning in their portfolios. University endowments, which manage money with infinite time horizons, maintain 5 to 15% cash allocations even during normal market environments. Looking at family office strategies, this data shows that billionaire wealth managers typically hold 10 to 20% in cash equivalents regardless of market conditions. They understand that preserving purchasing power during downturns creates more wealth than optimizing for every basis point of return during expansions. What emerges from ultra-wealthy positioning is that cash allocation should increase with uncertainty, not decrease. The most successful investors build cash positions before they need them, not after opportunities arise, which explains why institutional cash allocations have nearly doubled since 2021. This Fed cycle analysis demonstrates clear patterns in how cash and stocks perform during different monetary policy environments. When interest rates are rising and markets face uncertainty, cash consistently outperforms stocks on a risk-adjusted basis due to zero volatility and attractive yields. Looking at the historical data, this chart shows that cash provides superior Sharpe ratios during Fed tightening cycles because principal preservation becomes more valuable than return optimization. The current environment of high rates plus market volatility strongly favors cash positioning. What the cycle analysis reveals is that successful investing requires adaptive allocation based on risk-reward dynamics, not static asset allocation formulas. When cash yields 5% and stocks trade at 19x earnings with 1.9% dividend yields, the mathematics clearly favor cash for defensive positioning. This sharp ratio comparison shows why cash is mathematically superior to stocks in current market conditions. Cash delivers 5% returns with zero volatility, while stocks offer 7 to 8% expected returns with 20% volatility, making cash the clear winner on risk-adjusted performance metrics. Looking at modern portfolio theory, this analysis demonstrates that reducing portfolio volatility through cash allocation often increases long-term wealth accumulation. Lower volatility means less sequence risk, which is particularly important for investors approaching or in retirement. What the statistical framework reveals is that most investors focus on nominal returns while ignoring volatility-adjusted outcomes. A 5% return with zero risk beats a 10% return with 30% volatility when you factor in the psychological and financial costs of handling market turbulence. This market timing analysis shows that missing just the 10 worst market days over the past 30 years would have improved annual returns by 4.1%, demonstrating the mathematical value of defensive positioning. Cash provides the optionality to avoid major drawdowns while maintaining purchasing power. Looking at drawdown protection, this data reveals that avoiding 30 to 50% portfolio declines during bear markets creates more wealth than capturing every bull market gain. Cash positioning allows you to buy opportunities when others are forced to sell, creating systematic wealth transfer advantages. What emerges from opportunity cost analysis is that cash underperformance during bull markets gets more than compensated by drawdown avoidance during bear markets. The key insight is that wealth preservation during downturns matters more than return optimization during expansions. This life cycle analysis provides specific cash allocation guidance based on your investment timeline and financial situation. Young investors with steady income should maintain 10 to 15% cash allocation for opportunities without sacrificing long-term growth potential through excessive conservatism. Looking at pre-retirement positioning, this framework shows that investors nearing retirement should hold 20 to 30% cash allocation to reduce sequence risk and provide bridge funding during potential market downturns. This prevents forced selling during unfavorable market conditions. What emerges from personalized allocation strategy is that optimal cash percentages depend on individual circumstances, not generic advice. Investors with uncertain income or major expenses planned should maintain 30 to 50% cash allocation for security and flexibility, regardless of age. This valuation analysis demonstrates why current market conditions favor cash allocation over additional stock purchases. The S&P 500 trades at 19x price-to-earnings ratio while offering only 1.9% dividend yield, compared to 5% risk-free cash returns with zero principal risk. Looking at opportunity cost calculations, this data shows that paying 19x earnings for companies growing at 5 to 7% annually provides poor risk-reward compared to guaranteed 5% cash returns. The market's assumption of sustained high growth rates may prove optimistic given economic uncertainties. What the comparative framework reveals is that investment decisions should be based on risk-adjusted opportunity cost, not fear of missing out. When risk-free assets offer competitive returns to risk assets, intelligent allocation favors the certainty over speculation until risk premiums improve. This implementation strategy provides specific steps for optimizing your cash allocation in 2020 SIX's unique interest rate environment. First,